Welcome to Different Makes a Difference, where we discuss investment matters that matter to everyday investors. Join Odlum Brown's equity analysts as we examine pertinent topics in today's markets and look at things a little differently. Odlum Brown is an independent Canadian investment firm. We provide integrated wealth management solutions to help clients achieve their financial goals, and we've been doing so for over 100 years. Join us for some lessons we've learned along the way that can make a difference for the future. Okay, welcome back to Different Makes a Difference. My name is Laura McAleer, and I'm the Communications Coordinator in Odlum Brown's Research Department. Quarterly reporting is wrapping up, and as is usually the case, we're noticing a lot of overarching topics that keep bubbling up in management commentary across all sectors of the market. So with me today to discuss these core themes is Stephen Boland, our usual host of this podcast. Welcome, Steve.
Yeah, thanks, Laura.
So you've been an equity analyst for more than 20 years, and in that time, you've covered basically the whole gambit of the market. You've got industrials, consumer staples, consumer discretionary, a couple of companies in healthcare and materials. Can you start off by telling us what parallels you came across in all of this management commentary this quarter?
I think there were a few things that caught my ear this quarter. One is it's a massive part of the market's performance right now is what's going on in artificial intelligence. So certainly listening to hear what companies are saying about the build out of AI infrastructure, but also listening to are companies finding benefits from using AI and what are companies saying that might be at risk of AI disruption. Another thing that I think we all noted internally this year was some commentary around Canadian energy and potential build out to support of infrastructure to support Canadian energy industry. And given what's going on in the Middle East, the conflict with Iran, was quite curious to hear what companies were saying about the potential impact on their business and the potential impact on inflation from what's happening in Iran.
Yeah, so those headlines pretty much match the same headlines that everyday readers are seeing. So, well, let's dig into the AI piece then. What are you hearing about the build out and the opportunities there?
Generally speaking, still full speed ahead, it seems, on the build out. Companies that are selling equipment into data centers, their revenues, their orders, their backlogs just continue to grow in leaps and bounds. And stocks of companies that are perceived as AI beneficiaries, whether it's utility companies that generate the energy needed to power these data centers, some of the commodity producers like uranium companies, or even like Caterpillar equipment dealers, which might help mine copper, for example, which could be a beneficiary of that as well. So, still big questions about how all this plays out. Just because it's humming right now doesn't mean it will continue to. I'd invite listeners to revisit our podcast from, I guess, a couple of weeks ago, where we talked with Murray about what he sees in the AI infrastructure build out and why we might want to be a little bit more cautious there. But right now, it's certainly full steam ahead for companies.
So, well, that's the AI build out. What are you hearing from businesses about how they're incorporating it into their workflows? Are they actually gaining these efficiencies, or are we still just talking about the potential?
Still a lot to be determined here. And even internally, I know we're testing out AI a little bit to see how we might be able to benefit from it. And we're still trying to figure those things out. And I think that's the case with a lot of companies. There were some concrete examples of tangible benefits being delivered. And I think of Airbnb as one example where I noted a couple things. One is that 60% of its code right now is being co-produced by AI, so human engineers along with AI. And that's leading to a number of efficiencies, faster output, and the ability to iterate more quickly, and are using it as a way to improve the customer experience in ways. So customer support, I know we don't all love dealing with chatbots. You don't always get the answers you want, but they're finding it's helpful in improving some of those outputs. So they said that 40% of their issues are now resolved without a human agent when an AI assistant is used, which is a big increase from last year.
Yeah, that feels pretty high.
Getting faster resolution times as well. And there's cost savings associated with that.
So those are some of the beneficiaries. Who's struggling or at risk of this AI phenomenon?
Yeah, there's been a big theme in the market, particularly earlier in the year when software stocks were certainly the headline group. Companies like Salesforce and Intuit, which makes tax software, came down very significantly as people worried about the risk that AI could disrupt what have been very, very profitable business models. And we recommend shares in Constellation Software, which owns what's called vertical market software. So it could be software that runs a golf course reservation system or different transit systems and such. And we think ultimately they'll be fine, but it's certainly something we're watching. Consulting businesses, engineering businesses have come under pressure. We recommend a consulting business called CGI, and we're trying to figure out how AI might disrupt that business model, the whole idea of humans providing consulting services, and whether the revenue model there changes. So certainly watching that quite closely, and thus far still comfortable with our holdings there. And quite frankly, we're on the lookout to see if some of these other beaten up areas could provide opportunity.
Right. Yeah, because a depressed share price could be a good entry point.
It can be.
Yeah. Okay, so tell me more about the energy space and Canada's place in that.
There was a quote from Cenovus's CEO, one of the big oil companies here in Canada, and I know we talked about this a fair bit internally, and certainly got to recognize that the CEO of an energy company is going to talk up his book to some degree. But I think he was sending a message to a broader constituency. And, just to kind of paraphrase what he said, the world still, love it or lump it, the world still needs oil and natural gas for decades to come. And in his case, the oil has to be bought somewhere. So do you buy it in an unfriendly nation? Do you develop it in, Iran or Russia, places where maybe there's different abuses of whether it's labor or environment or what have you?
Right.
Or do you go to a friendlier country like Canada, which has, decades and decades of oil reserves? So I thought that was kind of interesting. And he highlighted how Canadian energy, it benefits us all every day. There's, big tax bases, there's royalties that are paid. And, I don't want to sound too much like a pro energy component here, but it funds it funds roads, it funds hospitals, it funds social programs, et cetera. So he's kind of saying, like, look, if the world needs it, and maybe over time we can wean away from it, but right now we need it, let's develop it in a responsible manner. And, Canada hasn't been particularly friendly to the oil industry the last number of years, but he's encouraging that maybe there's an opportunity here. We can build out more infrastructure and such. And, Prime Minister Mark Carney has been kind of talking a similar theme. So
yeah, there's definitely a shift in that government view on building out this infrastructure.
And it's one of the reasons that we're recommending an overweight position in Canadian energy stocks right now, because of this potential that we don't think is being paid for with the stocks.
Well, and the energy obviously is a natural segue into the war in Iran. That Strait of Hormuz has been closed for some time now, and that's 20% of global oil supply goes through that body of water, as well as other commodities. What are you hearing about the war in Iran and how that's affecting these businesses in the quarter?
Yeah, so corporate profitability remained quite strong this quarter. Earnings for the S&P 500, which is the main US index, that was up double digits year over year, and that's the sixth quarter in a row that has happened. So pretty strong there. Companies involved in AI were a big driver, but there was breadth beyond that as well. In Canada, energy companies are a big part of the economy, and commentary from them was generally positive. There was some cautionary commentary in areas, particularly around the consumer. So if we think of the US, the consumer is a huge part of the economy. And there's been this K shape going on for a while. So if you think of a K and one line is angling up, the other is angling down, one line's going higher, that's the higher income consumer that has generally been spending more. And the other line would be the lower income consumer, which is struggling. We went through a big bout of inflation not that long ago. That's still being felt. A number of mass market consumer companies have been posting mediocre growth. Consumer companies said they're watching for new signs of strain. So gasoline prices are high. That has a big impact on the consumer. And for the companies themselves, oil prices impact the cost of packaging, transportation, and even certain products themselves. These companies want to protect their profit margins, but can the consumer handle more price increases? And it's not just the US. Parts of Asia, for example, import a lot of commodity from the Middle East, so new pressure on consumers elsewhere as well. And if we just go a little bit broader, how much and how long will inflation stick with us? Maybe the US and Iran will have reached a deal by the time this podcast airs, but commodity pressures may not go away instantly. And there's inflationary drivers beyond just the Middle East. There's more people thinking that central banks could raise interest rates. Bond yields have moved higher. Government spending and debt loads are not helping there. And higher interest rates can slow the economy and can pressure asset prices. So corporate profitability is still quite good, still a lot of encouraging signs, but also signs of caution that we and the companies that we follow are watching.
So bringing it closer to home into the department, I can attest to the fact that we've been really busy in the last few months. We've had a number of big changes, rating changes in the companies that we cover. Can you summarize those big moves?
Yeah, it has been I would say, a busier than typical quarter. And just to put in perspective, we're very much buy and hold investors, longer term time horizon. I would say 5 to 10 years is typically how we think about the holding period for our stocks. But we put sells on a number of companies this quarter. 3 in particular are tied in with the AI infrastructure build out. So Vertiv, which is a name we'd owned for a few years and treated us very well. They sell equipment they sell cooling equipment and electrical and power equipment to data centers. GE Vernova, which makes and services gas turbines, and Cameco, which mines uranium. They've all benefited from the AI infrastructure build out, and the risk and return on these names just isn't quite what it once was. We worry that there's potential meaningful downside if the AI trade kind of pulls back, and we still feel we have AI exposure through companies like Microsoft and Amazon and Google, where we just feel better about the risk and return of those names. We've changed our recommendation on Procter and Gamble to sell, name we've covered since 2009. Still an awesome company. We just feel that our other consumer staple companies look a little better here. And Thermo Fisher is an example of one where you always kind of go back and retest your thesis, and sometimes it didn't quite work out as planned. The stock kind of did, I think, okay while we covered it, but not as good as expected. And historically, they've been pretty good with acquisitions. But when we look back at past acquisitions, they just didn't deliver the returns that we expected. So there were some names that we changed to sell, but we had some new buy recommendations as well. Yeah. And I'd encourage people, we've got podcasts on each of these over the last few months, but Airbnb, James Hardie, and Moody's. So Airbnb, I think most people are quite familiar with, and big global network of alternative accommodations, and expanding into new areas of travel. So experiencers, for example, and services. And they just came out with a whole new host of offerings. So for example, if I'm traveling to Europe and I want groceries waiting for me when I get to my Airbnb, they have a partnership now with Instacart that can do that. Yeah. James Hardie owns Hardie Board, which I think you're quite familiar with as a new homeowner. And they did an acquisition of a composite decking company, which the market did not like, but we think provided an opportunity for us to get in. And just to go back, we talked at the beginning about some software companies under pressure from AI. We think that opened up an opportunity in an awesome global business called Moody's, which is a credit rating agency where we think its durability is still quite strong, super profitable business, and the stock trading lower than it had been because of these, what we think are overstated AI concerns.
Right. So those are new additions to the coverage list. And as the quarter unfolds, there's always some big movers, ups and downs in our coverage list. Can you take me through who is struggling right now?
Okay. We'll start with the downs. And
the bad news.
Unfortunately, you're always going to have downs in a portfolio. It'd be great if every stock went straight to the moon, but that's not realistic. And we have diversified portfolios partly for that reason. So when I think about a couple that had poor stock performance in the quarter, one was a company called Vontier. They sell equipment to gas stations. So think fuel pumps, some of the underground sensors, some of the payment systems. Really profitable company, and it's the biggest in a number of areas where it competes. Its margins were a little bit lower than expected this quarter. They still expect to make margin improvement this year, and I think there's a bit of potential beyond that. Earnings should still grow at a pretty decent pace, but the stock sold off, and I think management's doing the right thing. They're actually accelerating their share buybacks with the lower share price, which means each of us shareholders will own a little bit more of the company when those buybacks are completed. GE Healthcare, which is part of the old General Electric conglomerate, They sell and service diagnostic imaging equipment. So think MRI, CT scanners, X-rays. Very profitable company, but they lowered their guidance for this year's earnings a little bit because some of it traces back to the Mideast conflict and transportation costs, but also memory chip shortage. And that's something they have to work through as well. So a bit of pressure on margins, but at the end of the day, it still operates in an attractive industry where there's few competitors and it's hard for new competitors to get in. And there's demographic tailwind with aging population and I think an inexpensive stock.
Yeah. Well, that's great. And so who's flying high then this quarter?
Yeah, we had some of them too, which is always nice to see. One would be Alphabet. And Alphabet's the parent company of Google and just had humongous growth both on revenue and earnings this quarter. Interestingly, last year, this was viewed as an AI loser. Its first AI product demonstration did not go well. People thought that their search business could be disrupted, but fast forward a year or so, and all of a sudden it's deemed as an AI winner. It's come out with better product, and the stock is re-rated from the teens to a high 20s PE multiple. Certainly, we liked it more when it was more depressed, but still think it's a business that we want to own because it's a profitable company. We think it can be an AI winner. It has just fantastic franchises. It's search business, it's cloud business, owns YouTube, which is growing quickly, Android, got Waymo, the autonomous vehicles. So still looks like a good holding here. And then Magnum Ice Cream going a slightly different route. And interesting, this is one where most of the old Bob Dylan, the losers now will be later to win. And the way I think the times are changing, but I was watching that movie the weekend. So Magnum Ice Cream, making ice cream. They had a tough quarter last January. Sales were a little bit lighter than expected, but this year this quarter sales were better than expected. And they own Magnum and Ben and Jerry's and a lot of other big global ice cream brands. They're the world's biggest. And we think they can grow at a decent rate over time. And they've got some margin expansion potential as well in a pretty cheap stock. So that's a name we continue to like.
Well, that's great. So you'd be buying all of these companies now then?
Yeah, they all look pretty good.
Well, that's a pretty good wrap up, I think, of the quarter. There's obviously some big headlines to keep an eye on, but there's also lots of opportunities too that we're finding. So an exciting time, I think, to be an analyst, I would imagine, being busier in the department. Yeah.
And actually the divide between there's some big winners and there's some big losers. It's actually a pretty good environment to go look. It doesn't mean every loser is going to work out and every winner is going to fall.
Right.
You kind of usually want a bit of both.
Yeah, you have to kick the tires on these
exactly,
things, but it gives you more to look at for sure.
Yeah, lots to be looking at.
Well, thanks so much, Steve, for breaking it all down for us. I look forward to talking again.
Great.
Thank you for listening to another episode of Different Makes a Difference. Just as every individual is unique, so are your financial circumstances. Be sure to talk to your professional advisors for advice related specifically to you. Our podcast is for general information purposes for Canadians only. The views expressed are those of the presenters and may not reflect the opinions of Odlum Brown. Be sure to check out our full disclaimer and subscribe to the podcast at odlumbrown.com/differentmakesadifference. Odlum Brown is a member of the Canadian Investor Protection Fund.